will be triggered at some point, and when it does, the Fed will reverse from QT to QE and push interest rates back down to zero very quickly. That is when I expect the final run of gold versus the dollar to head to the sky now.
As we approach the year end, one question looms large. Will the repo market implode? And if it does, could this finally be the moment gold stocks start to win? Every December, banks fight for cash, and the repo market feels the strain. But this year, the pressure's on like never before. Could we be staring at a financial meltdown? And what happens if the system falters? History shows us, when the cracks appear, gold becomes the hero. Could this be the spark that ignites a gold stock rally? In this video, Rafi Farber will reveal why the year-end turn is so dangerous, what it means for your money, and how gold stocks could finally break out. Stay with me, because what happens next could change everything for gold, the markets, and your portfolio.
Here's this week's silver report, and today we're going to talk about when mining stocks, mining shares, gold stocks, silver stocks will finally explode higher in real purchasing power terms. And we're going to use a parallel bull market as an example of what these stocks did in the past and what they're likely to do once we have a revaluation of the dollar or the death of the dollar. It's really both the same thing. You might be surprised to realize that from 1974 all the way through the 1980 top in gold and silver stocks did not do much of anything. So then why would they do anything now? The answer is because this time it will be more like the 1971 to 74 gold bull market, which was at the beginning of a revaluation of gold, the end of the gold window, the end of the last vestiges of the gold standard. And we are now at the end of the last vestiges of the fiat money system, and gold and silver will be money once again. And at that point, gold stocks are going to go much, much higher in real purchasing power because they will be the only ones that will be able to pay dividends in real money terms. Everyone else will pay dividends in dollars, which won't be worth much of anything. And so the quick answer as to why own any gold stocks at all, any silver stocks at all, is not because they will go up leading up to the end game, but because they will provide a source of income through and after the end game. That is why you should own any gold and silver stocks at all. And I'll show you these parallels in the charts. They are very clear. So this, my friends, is a chart of Homestake mining from 1969 to 1982. This is the premier gold stock. I guess the equivalent of Newmont would be today. So you see here 1969 to 1974. That is this first box over here, and I labeled it. We have a 5x increase in the first leg of the bull market. From 1974, 1976 was when the Treasury was busy selling gold to try to control its price, and we had a little correction in the midst of a bull market that went into 1980. But from 1974 until 1980, this stock, Homestake Mining, which could be representative of other gold stocks of the time, it actually went down. It did not even hit a new high in January 21st, 1980 top, with gold at 872 and silver at $50. It hit a new high later on in 1981 as interest rates maxed out. However, that was a short-lived high, and good luck timing that thing and expecting that you'd be able to sell at the top in this gold stock, as gold had already topped. Very confusing. I don't expect anyone to be able to sell at a high like this. So you could be saying then, and I would say, why would anyone want to own any gold or silver stocks now, given that this is what the gold stock sector did in the 1970s? In this next chart, we can see in the blue, again, is Homestake Mining, and in the black is the Dow. So we can see here is the top in the Dow in mid-1929. Here's the crash of 29 over here. And what was Homestake doing there? Homestake had a peak as the stock market in general peaked. It did trade in tandem. However, there was not a concurrent fall. There was no concurrent fall in Homestake Mining as the Dow kept getting lower and lower and lower, and the bubble deflated further and further and further. This stock just kept going higher and higher and higher. And see, here is the gold revaluation from $21 to close to $35. And at that revaluation, that is when home stake mining really started to take off. It really took off once the Dow bottomed over here. We have home stake mining over here, slightly above it. And then after the Dow started to reinflate slightly, nowhere near as where it was in 1929, but as the Dow started to reinflate after this whole monetary system had ended and we went into a new era of gold standard-esque monetary regime, that is when home stake mining really started to take off into 1936, reached a high then. So the point here is that we shouldn't expect gold stocks to really start to revalue higher until during and after the endgame itself. The Dow bottomed here. So once the Dow bottoms and the dollar regime is pretty much over, that is when these gold mining stocks are going to seriously outperform the market. Remember, not only was home stake mining making new highs for itself, it was making tremendous new highs relative to the stock market, relative to the Dow here. So I'm expecting in terms of purchasing power that these stocks will go up at least 10 times and they will be able to pay a real income stream in perhaps certificates for their product in real money terms. And now I wanted to go into an article in Bloomberg about the year-end turn into 2025 and what could happen in leading up to it and in the short months afterward. We do not have a lot of time, and Bloomberg is confirming this as well. And I'm seeing a lot of emails and articles and all this other stuff. Will 2025 be the year of the reset? Lots of people on our side of the monetary spectrum believe that it will be. We'll see if it finally rings. Treasury's elite bond dealers will struggle to handle $50 trillion debt. Just wanted to go into a few key paragraphs here. Here is the first one that I wanted to highlight. They worry about the potential for the type of breakdown in Treasury market functioning that happened at the start of the pandemic, when investors rushed to sell bonds as panic set in. U.S. government debt sold off sharply until the Fed implemented an emergency backstop measures to limit the damage. The fear is that a confluence of pressures could strain liquidity and spur dislocations even without an obvious fundamental trigger. So essentially, they're saying this is going to happen randomly with or without a trigger, meaning it could happen in the year-end turn, which happens in the next 2 days, or it could just happen randomly in the time afterward. The other paragraph I wanted to highlight is this one. A key risk for the market is that if repo rates surge again unexpectedly, and dealers aren't in a position to step in, hedge funds may not have properly factored in that risk, triggering swift and violent deleveraging that would likely prompt the Fed to intervene. Regulators continue to fret about potential disruptions around the popular basis trade. We'll get into that in a second. A leveraged bet that seeks to exploit differences between cash treasuries and futures, given the prevalence of hedge funds on one side, who have stepped into a role formerly taken by primary dealers. And so what is this talking about? I will show you in one scary looking chart right now. This is the basis trade. It should scare the pants off any central banker, especially an American central banker, meaning anyone on the Federal Reserve Board. The blue line is the hedge funds, and it shows how short they are. Treasury bonds is exactly what that last paragraph was talking about, how the hedge funds have taken up the job of the primary dealers. The primary dealers aren't dealing with this for whatever reason, and instead the hedge funds are dealing with it by shorting Treasury futures and buying spot. And that depends on futures being more expensive than spot, which reverses itself in a liquidity crunch as we saw in 2020. And this whole thing is forced to wind down. Will be triggered at some point, and when it does, the Fed will reverse from QT to QE and push interest rates back down to zero very quickly. That is when I expect the final run of gold versus the dollar to head to the sky. I don't know where the sky is, but it's a lot higher than where I am now.